lecture 1 of IFRS, which is Conceptual Framework. Today we are going to look at the Conceptual Framework of IFRS. So what we are going to learn in this lecture is 1. The purpose of a Conceptual Framework, the qualitative characteristics of useful financial information, elements of financial statement, recognition and derecognition, measurement, presentation, disclosure, and aggregation. So let's look at the purpose of conceptual framework. Conceptual framework is to assist the ASB, that is the board, in developing new IFRS standard and review of existing one. So this ISB means International Accounting Standards Board. So this board is the one in charge of developing new accounting standards. So this conceptual framework assists this board whenever they want to develop new standard or they want to review the existing standard. That is one. Number 2 is to assist preparers of financial statement in applying IFRS and dealing with issues not covered under IFRS standards. So whenever preparers of financial statement you want to prepare their financial statement, they have to now look into the conceptual framework. And whenever there is no existing IFRS standard that covers a particular transaction, then they have to refer back to the conceptual framework. That is the second purpose of the conceptual framework. The third one is all parties when understanding and interpreting IFRS standards. So all the parties, whether the preparers of financial statement, the users of this financial statement, they are to refer back to the conceptual framework in order to have more understanding of the IFRS standards. This conceptual framework is not an accounting standard. It does not override the requirement in a particular IFRS standard. This means that the conceptual framework is not an accounting standard and it does not override any accounting standard. In a situation whereby there is accounting standard, so you are to comply with whatever that standard says, and whenever there is no accounting standard, then you are to use a conceptual framework as your guideline. Then to assist national or local accounting standard setting bodies in developing quality national standard. So whenever local accounting standard body, that is national, it is in every country they have their own local accounting standards. So whenever those that do not comply with IFRS, they have their local accounting standards as at now. So whenever they want to develop new standard, they can refer back to their conceptual framework, where like in US, they have US GAAP. They have US GAAP. So they are not using IFRS, they are using USA GAAP. So this US GAAP, they have to refer to the conceptual framework so that it will assist them in developing new accounting standards or reviewing the existing accounting standard. So we have the qualitative characteristics of financial statement. This qualitative characteristics of financial statement is divided into two. Qualitative characteristics of financial statement. So it's divided into two. We have fundamentals quality, which is this fundamental qualities, and we have enhancing qualities. we have fundamental, enhancing qualities. So under fundamental qualities is also divided into two. Under this, we have relevancy, and we have faithful representation. So under relevancy, we have predictive values, have complementary values. Under faithful representation, we have completeness, neutrality, freedom, free from errors. Then under enhancing qualities, we have understandability, comparability, variability, timeless. So these are the things that we have under qualitative characteristics of financial statement. So now we are going to look at all these elements now. So now we are going to start with the fundamental qualities. I said we have relevant, we have faithful representation. So let's start with relevance. What is relevance? This means that the financial statement should be prepared to contain information that is relevant to users. The relevance information is affected by its nature and materiality. What this means is that the information contained in that financial statement, it must be useful to the users of that financial statement. You cannot include information that is not relevant to the users of that financial statement. It's not everything that you will put in your financial statement. You are expected to use only information that is relevant in that your financial statement. And under this, I said we have predictive value. This predictive value is the ability of information to assist users to make reasonable prediction about the expected performance and position of the reporting entity in the nearest future. This means is that the information you are providing in your financial statement, it must be predictive. You must have value that the user of that financial statement can predict what will happen in the future. They will use the current figures and predict what will happen in the future. That is what this predictive value means. Then we have a confirmatory value. The confirmatory value is the ability of the information to assist the users confirm the predictions made in the past. This may be involved comparing the actual result with the expected result of an entity. This means so the users of this financial information, as far as the financial information contains relevant information, so they will be able to compare their budgets with the actual. That is so that they can analyze the variance, whether positive variance or negative variance. They can analyze it. That is what this means. Then materiality. This materiality, the information is material if omitting this information or misstating information can mislead the users of this financial statement. Once an information is omitted in the financial statement, and as a result of that, it misleads the users of that users of the financial information, then this information is material. That is what we have under relevance. Then we have faithful representation. This means that the financial statement should be prepared and presented with all honesty to show the actual transactions that occur during the reporting period to achieve faithful representation. So this information must be complete, must be neutral, and must be free from error. So what this is saying is that information you are expected to include in your financial information must be complete, must be free from bias, must be free from error, is what this is saying. So we can now go to the other side, which is the enhancing characteristics. What this means is we have comparability. Financial statements should be prepared in a way that it will be it will enable users to compare financial statements with another entity's financial statement to evaluate performance and position. This means the comparability simply means that the financial statement can be used to compare financial statement of another company. That is, users of that financial statement, they have to analyze their financial statement. So in the process of that analysis, they can compare financial statement of company A and that of financial statement of company B, or they can compare the financial statement of this year and financial statement of the last year. That is comparability. Then timeliness. Financial statements should be available to users immediately after reporting period. This means is that the users of financial statement expect financial statement to be with them, to be available for them within a short period of time immediately after signing of that financial statement, so that they can make their decisions. Then verifiability. Different knowledgeable users should be able to agree that a particular financial statement offers faithful representation. What this means is that they can verify it. Different users of financial statement are expected to reach the same conclusion that yes, this information contains the true and fair position of an entity. Then understandability. Financial statements should be prepared and presented in such a way that it can easily be understood by users. Means the users of financial statement are expected to read that financial statement and understand it without involving another expert to come and interpret that financial statement to them. So financial statement should be understood by users of that financial statement. So now we are going to look at the element of financial statement. Under element of financial statement, we have some elements that are in financial position, some are in income or loss and other comprehensive statements. So we are now going to look at them. Under it, we have assets, liabilities, equity, income, expenses. So these are the elements of a financial statement. Then we are going to look at the component of the financial statement. According to IAS 1, presentation of financial statement, complete set of financial statements should include the following. One, we have a statement of financial position. We have statement of profit or loss and other comprehensive income, statement of changes in equity, statement of cash flow, and note to the accounts. So the complete set of financial statement must have all this. And financial statements are prepared on the assumption that entity is a going concern. This means that it will continue to operate for the foreseeable future. If this assumption is not accurate, then the financial statement should be prepared on different accounting basis. This means is that financial an entity, companies are expected to exist for foreseeable future. But whenever we have different opinion concerning that company, then we cannot prepare the financial statement as a going concern. We have to prepare it on a different basis. So now we are going to look at the elements of this financial statement as explained, as stated earlier. So now we are going to explain all of them. We have asset, liability, equity, income, and expenses. So we are now going to look at these 5 items. Asset. Now, asset present economic resources controlled by an entity as a result of past event. Asset is whenever an entity has control over a particular item and there is economic inflow, it will flow into that entity, and something happened before you now have that control. So that is an asset. Then a liability. present obligation of an entity to transfer an economic resources as a result of past events. Obligations. The entity has an obligation to settle another person, that is third party. So what this means is that maybe you enjoy service or you purchase some equipment from another person, but you have not settled that. So there is an obligation that there will be an outflow of economic resources. That is what this means. Then residual interest in the net asset of an entity. That is what equity means. Then income. This is an increase or decrease in assets or decrease in liability that results in an increase in equity. So whenever your asset increases and your liability decreases, you have an income. So then expense. This decrease in asset or increase in liability that result in decrease in equity. This is the reverse of income. So this is the decrease in your asset and increase in liability. Then we are going to look at recognition. Recognition. This is the process of incorporating or including an item in the financial statement. So this recognition is whereby an item in financial statement is included, is incorporated. You bought an asset. So what are you supposed to do with that asset? Are you not supposed to recognize it? Are you not supposed to register it in your asset register? So that is what this means. As far as that asset meets all the requirements of IS 16, so you are expected to recognize that asset. That is what the process of recognizing that asset, incorporating it in your financial statement, that is recognition. Elements are recognized if recognition provides users with useful financial information. In other words, must provide relevant information about that particular item, a faithful representation of asset or liability. Then under this, we are going to look at how asset and liability are being recognized in the financial statement. First of all, let's look at how asset is being recognized. Then the amount or item meets the definition of assets. So I already said this. Once assets meet the requirement and definition of IS 16, you quickly recognize it. Then number 2, it is probable that the item or amount will produce economic benefit to the reporting entity is the second one. Then the cost or amount to be recognized can be reliably estimated. You can estimate that amount. Whatever you cannot estimate, you cannot even include it in your financial statement. Then now let's look at how liability will be recognized in the statement of financial position. And the amount or item meet the definition of liability, then it is probable that the item or amount will require the reporting entity to transfer economic benefit to another party or parties. The amount of the obligation to be recognized can easily be estimated. So that is what this means. Then recognition of income and expenses in the statement of profit or loss and other comprehensive income. The other one, the one we just finished, is in financial position. So now we are going to look at our profit or loss and other comprehensive income. An amount or item is recognized as income when it is earned by the reporting entity. When it is earned by reporting entity. Then second one, an amount or item is recognized as an expense when it is incurred by the reporting entity. So these are the two main features that you can recognize item in your statement of profit or loss and other comprehensive income. So now we are going to look at the recognition. We have treated recognition now. Now we are looking at derecognition. What is this derecognition? you have included item in your financial statement. So how can you now remove it from your financial statement? Since you included it, you have to remove it sometimes. So that is what this means. This is the removal of all or part of recognized asset or liability from statement of financial position. This normally occur when the entity loses control of the asset. When entity does not have control of an asset, what else? You recognize that asset, you remove it from your financial statement. Then has no present obligation for the liability. Once you have settled all your liabilities, what are you expected to do? You are supposed to remove it from your financial statement. Is it? Then measurement. When recognized in the financial statement, element must be quantified in monetary terms. So element, that item that you want to recognize in your financial statement, what is the monetary value of that item? So it must have monetary value. Just like IS2 inventories. Under IS2 inventory, first the first initial recognition says what? You have to recognize it as costs. Then subsequent recognition, say NRV. That is NRV, cost and lower of NRV. Anyone that is lower, either your cost or NRV, you have to recognize that amount. So you see, there is something that you will recognize. So what is that something? Is the monetary term. So that is what measurement is saying. The conceptual framework outlines two broad measurement bases, which is historical costs, which I just explained now, then the current value. This current value includes fair value, value in use, and current costs. Presentation and disclosure. Information must be well presented in the financial statement and relevant disclosure must be made. This means that information in your financial statement must be well presented in such a way that every user will interpret it, will understand what that means. It is disclosure. There are some informations that you cannot put them in the first of that your financial statement, but you have to disclose. You have to put it in the note to the accounts. Have to state it, because without stating that, it will mislead the users of that financial statement. You have to now state it. Aggregation refers to the adding together of items that have shared characteristics. For instance, when you have 2 or let's say 5 items and they have the same qualities, what are you supposed to do? You are supposed to aggregate them, you put them together and recognize them in your financial statement as one item once they have that the same features. So this is the end of these lectures. Thank you so much.